Welcome to another episode of the Index podcast, where we come together every couple of weeks to discuss on-chain data, chart crimes, and metrics that move the crypto industry. Today I have with me Hildoby, resident data house of Dragonfly.
Hello, everyone.
Danning, chief on-chain sleuth at Pantera Capital.
Hi.
And I am, of course, Boxer, the community powers at Dune. Before we start, nothing we say here should be relied upon as legal, financial, investment, tax, or even life advice. We're acting independently of our respective professional roles. And with that, today it's just the three of us, and we thought it might be nice to do a little bit of hot takes for the year-end episode. So both Dobby, Danning, and me have prepared kind of a little section. I think we'll go from is there enough TPS? Do we have enough block space? Have we kind of reached scalability of blockchains? We're gonna dive a little bit into that. Then Danning is gonna talk about the state of DeFi, and I'm gonna finish it off with what are the chains that exist, and how do they differentiate from each other, and maybe which chains have gained and won something this year. And with that, I think Dobby, you can take it away on. Have we reached scalability of blockchains? I don't know. What's the title for this section? That doesn't sound like proper English.
My angle, that the way I put it is are blockchains ready for the real world? It is a question that could be answered in many ways. And you mentioned block space. That's one thing, but I think block space has been largely seen as not necessarily the bottleneck anymore. We have sufficient block space, and it's not the bottleneck of blockchains currently. Throughput and latency, as often advertised by Solana, is essentially what we're after. So I wanted to look at, do we have enough throughput, essentially? And by throughput, to put it lightly here, I looked at TPS, because I think that not necessarily the same thing, because TPS can carry different amounts of throughput, of course, different amounts of data. But if we reach sufficient TPS, then we can actually look into sufficient throughput and data per TPS. But I think it's a step-by-step thing, if that makes sense.
Yeah. To jump into the nuance that you were defining, because in the very beginning, I remember in our draft, it was, is there enough block space? And I just throw that into a poll, into the data group, and also on Twitter. And surprisingly, I voted yes. I think there's enough block space, as in there's so many L1, L2 as of today, and everybody's trying to make the block space cheaper. And to my surprise, actually, overwhelmingly, people do all agree that there is enough block space. Well, the reason why it's surprising is because I thought, to be aligned, everybody is saying we should still need more space and cheaper space. But yeah, I think the definition of TPS is much more nuanced than just the block space, because it has to be faster as well to really have the real world user experience, that without knowing, say if you are trying to make a payment real, do you have to wait for 12 seconds to fill the block time, etc. So with that, I think please bring us the data you prepared.
Yes, ma'am, on it. Here, I want to keep it more high level and give you the ballpark idea with the numbers. That's also why you'll see a lot of numbers that don't necessarily have exact sources, because I found them thrown around and it's the best I could find for those, but there may not be not exact sources. So FYI, think in terms of ballpark numbers, not in exact science here, because those are usually published by companies that don't necessarily want their data to be fully accessible and have competitors and stuff. And it's a different world than the blockchain world where everything's public. Anyways, with that out of the way, I wanted to look at, like I said, are blockchains ready for the real world? And I wanted to look at real world applications where blockchains could actually play a role and eventually replace what we currently have with what I think to be better systems. The most obvious one is going to be, it's usually payment processors, as PayPal, MasterCard, Visa. In total, they process 2,300 TPS and max throughput of 70,000. So I'm going to fire through those. It's not about the exact numbers and stalling on all of them. There's also domestic payment networks. So that's inside of each country. India has the biggest with 129 billion. Those are the numbers for 2024, total numbers. And essentially there's 266 billion transaction in 2024, which accounts for about 8,400 TPS if you smooth it out. That doesn't include, obviously, max throughput that's probably burst on days like, I don't know, leading up to Christmas or Black Friday, or I don't actually know when burst happened, but, stuff like this, and probably also different at different times of the day. I assume, there's just times of the day where there's just more transactions. So it's not obviously a smooth out 8,400, but it's just, again, use it as a ballpark idea. There's also centralized finance. For this, I looked at Charles Schwab's numbers. And if you look at essentially what they have in terms of market share, which is 27%, and the amount they're managing and the numbers I could find put them into the essentially 98 TPS. And if you put it in total, given the market share and everything, that's about 1,000 to 2,000 TPS. So that's for, options trading and all of the kinds of centralized finance that take place. Then we have collectibles in terms of gaming. So if you think about like Fortnite moving on chain for their marketplace, whether it's primary or secondary, so essentially just having NFT marketplaces for gaming, Fortnite would put it at like 19 TPS. So my assumption is that Fortnite being one of the biggest game there is in terms of primary market activity, although there's not really much of a secondary. I don't think so. Counter-Strike is another one that has more secondary activity. But I assume that would be like under 1,000 TPS across all of gaming in its current state. And then another one, I think this was more of a thing a few years back when we had chains like VeChain and stuff like this, but essentially supply chain transparency. And yeah, I looked into it because it was a little while ago and it just rang a bell. And just to track all goods sold out in the world and essentially having points of contact of like when it was actually created, when it was, which carrier was used, and having like blockchains used to timestamp and actually put some kind of verifier of where your product came from, which I think would be cool in a future. That would put us like 100,000 products sold a day. That's a very ballpark number. There's not really much of a number here. And given like, let's say 3 points of contact per product, I'll put us at like 300 TPS. So anyways, that's like ballpark ideas for use cases that have flown around crypto that would be relatively high TPS. I'm curious, first of all, if you have any feedback here on it's obviously not a perfect selection. There's many more. It's just like the ones that came top of mind. And yeah, what do you think here? Do you actually see those as being what crypto is used for in the future?
I think everything except like the logistics thing. The logistics.
So no supply chain.
I don't like.
I don't agree. I think supply chain has a very good use case. Like, I don't know if you guys know, it's there is this like such a, how to say, trust issue in China about food quality for everybody in daily life. Because like now when you go to a restaurant, or like a lot of people order takeouts, and when you get the food, it sometimes comes in to your door in 5 minutes, and you're like, how can they make this food in 5 minutes? It's all pre-made. Like it's all actually like pre-made in factory and like distributed, and maybe have like insane long long time for the food to be able to keep it fresh. Obviously added like chemical in it. So I think like supply chain that can actually give trust to consumers could be very interesting use case in the future. And I think actually it's a use case that doesn't really require maybe too much of a real-time TPS, as long as you can track it like over hours and days. Maybe it's not a problem.
I don't think it's about real time, but more about a scale issue where there's just a lot of things that would need to be tracked if you were to do this. I don't know. I kind of see supply chain transparency as something that would be really cool for the consumer. It's just not really possible technically currently, because to do that, the way I see it is you would need it to be posted on some place do you actually trust. Like if it's just posted by the person that sold the product, then it's not really much more of a guarantee than what's already written on the packet, right? But if there's some place that is more trusted by all parties, and, you know, only let's say it goes through a warehouse and only the warehouse has the access key to post, you know, that it came through here, then therefore there's probably some better trust guarantees that it actually made it in there. I don't know.
I feel like Web 2 doesn't even have solved this problem. Like, this is nothing you can just like kind of throw a blockchain at. This is like such a large scale coordination problem that like I'm not very. I don't know. I think this is just a really hard problem to solve. Like I can't even, like, I have packages that I just don't know where they went. Like, it's not even a solved problem. So like, how would a blockchain like? So I don't know. Like a blockchain, like sure, it needs like this kind of neutral third party place, or like this like whatever decentralized trust that like would enable some of this, but I feel like we're so far away from like actually being a reality.
Oh, it's a while ago. It's a while away for sure. But I don't mean necessarily like lost packages. It's more about like, I'm buying meat. Where did it come from? I just want to know, you know, was it actually made by in an actual farm, or was it in like, you know, like it gives you some sense of quality as well as when it was actually produced and stuff. And those are things that I believe as a consumer would be really good to have.
Actually, those are like fairly well standardized within Europe. Like meat and eggs and stuff, like they always have like codes that you can like follow them to wherever they come from. Yeah, that's true. But I think we're in the privileged part of the world with that. Yeah, definitely.
But yeah, anyways, let's not ramble on this too long. Anyways, it's more about like, again, the scale and what we need if we were to have these kind of things on blockchain, which I think there's some possibility here, but whatever. It's a long way anyway, anyways. But let's see how much TPS we actually have available. So I looked into a few top blockchains here. Ethereum, Solana, Tron, Base, BNB, Ton, Avalanche, Near, Aptos, Sui, Arbitrum, and OP mainnet, which total about 1,600 TPS across all of them. And in terms of max burst that has been observed, which is like calculated as like 100 block spans of transactions, those total 30,000 TPS. 30.7 to be more precise. And of course, it doesn't include our blockchains. I'm even helped here by the fact that I didn't include stuff like Monad that recently launched, but I think it's, I need to look back into Monad a bit more at the start of 2026. And there's also Mega ETH that will also be high throughput. So there's definitely chains that are launching with the idea that we need more TPS. I think there's definitely a trend here. Of course, I'm biased. Both of those are Dragonfly portfolio companies. But but there's also another aspect, which is, of course, if we have TPS, like how decentralized are these blockchains? And many of those, I think, like Ethereum, Solana, are largely decentralized enough to be trusted by all parties. But I don't think it's the case for all of those. And I think the end game scenario that I envision is a blockchain where both, you know, China and the US can both use and post on, as well as trust it with the knowledge that the other is unable to censor it. And I don't think that's remotely the case yet for a lot of those blockchains on the list. So ballpark ideas, 30,000. And if we look back at like how many we need for the application I use, it's like 300 to 400,000. So at least like an order of magnitude down to what we would need just for those applications. And then there's a lot more, actually. There's more applications that could come born out of these technology rising up. Of course, there's prediction markets that are, you know, a new category that are popping up. There's agents, there's micropayments. And I do believe that those would require more TPS than all the rest combined before in an eventual future. So yeah, eventually we need a lot more TPS is I guess what I'm getting at.
Do you guys
curious about your guys' thoughts on this?
If there's a chain gonna solve this or like have the highest TPS, do you think it's gonna be Mega ETH or Tempo or Solana?
I don't think any. I do like the monolithic idea that Solana started with, and that some of the chains are trying to do. But I don't think any single chain is going to host the whole world ever. And I don't think it would be a good idea either to be all reliant on one system. Even if trusted fully and everything, I think it's nice to have diversification, right?
But I mean, yeah, that's the ideal case. But in the end of the day, it's whichever chain has a distribution, right? Like I think if there's a sign showing that Tempo is gonna have a deal or partnership with like DoorDash and other like real world apps, so it seems like they are having I think like the highest momentum from at least what I'm watching. But yeah, I agree. There's no absolute winner at the moment yet. But I also want to caveat like this metrics is definitely tricky to define and compare because TPS people in the past have argued against, as in like, you know, it doesn't make any sense. Like gas per second makes more sense. But I mean, I think it's that one doesn't really stand neither because like each chain may have different design, cost different amount of gas for the same action as well. And so it's really like, yeah, like for different use cases, maybe supply chain case, it's like really just logging in a information. So one transaction can cost less, consume less gas. And so the size of the transaction may be smaller. So TPS can be bigger as well. So I feel like, yeah, even though the number right now looks like TPS for across all the chain is small combined, we might be able to handle more than what we see in the numbers.
Yeah, no, I agree. I think it is a really, really shitty metric to look at. Just to caveat, but for the purpose I was looking at, the thing I was trying to look at, I think it's a decent ballpark idea that can be used. But I definitely agree with all you said about like it's just not like please don't use that metric as just a showcase of like how my blockchain is better, because it's like all the high bursts of TPS that have been shown for like marketing purposes, they've all been done with like really, really non-useful transactions bundled in there, because those cost the least. And obviously with, you know, non-costly transaction, you can burst a lot more into a single block. But yeah, once we have essentially, my idea is like once we have enough TPS, we can also maybe look actually deeper. If we look at like the grand scheme of thing and actually look into gas per second as a macro thing across all blockchains. But for single blockchains, please, I don't think it's the thing you should look at. And gas per second is definitely much better.
I think there's two different questions here. One is like, do we have enough block space to do what we want to today? And then is there enough block space to like fully onboard everything and everyone to blockchains? I think on the first question, and I think that's how most people would interpret that question if you just post it in some group chat. It's like, yeah, we have more than enough block space to do whatever we want to do today. And like there isn't really that like people are not onboarding to blockchains because the fees are too high or because transactions are too slow. They're like the overall UX and like the usefulness of the products is like still too bad. But like I don't think TPS is like necessarily a problem. On the builder side, I think you much more have the problem of like, oh, if I build an application that's like trying to do logistics at a large scale or something, that might be like, okay, like I might not be able to use a blockchain here. So I think very, very kind of like very nuanced discussion to have.
Well, I think for like current use case, we have the case of like 2021 where essentially gas fees skyrocketed on Ethereum because people were trading NFTs and doing all kinds of things. And we essentially reached a point where we're like, oh, like actually the blockchain is not ready for the use case back then because it was fairly costly to use and had high congestion. So it kind of pushed a lot of people away from using it. And my assumption is that we're hopefully by the next wave of huge use case we have, which we've had in a couple of scenarios, but I wouldn't say as big as the 21 relative to the space we have on chain. Hopefully by then it's more ready to host everyone with high TPS. And I'm not really confident we're there yet.
I think the Trump, like literally the president of the United States of America launched a meme coin on Solana. And for most of the time, like only when the second meme coin hit the blockchain, did Solana fall. Like, you know, it actually survived. Like the actual Trump launch, like Solana survived pretty well. Only when Melania launched, like, it was too much. So I honestly, like, that was like such a good pressure test, and like still kudos to Solana for like surviving all of that and like being able to serve most users with kind of good UX. Of course, there was also like need to pay like priority fees, and like things weren't like as cheap anymore, and like I don't know that, but like still it was nothing in comparison to Ethereum. Like I think you'd pay like a $10 priority fee or something for a trade to go through. And of course, you'd always get sandwiched, and slippage was horrible and all of that stuff. But like at the end of the day, those people who wanted to buy the Trump token could buy the Trump token for the most part. I think eventually, like Jito's infrastructure kind of crumbled away, and then you were no longer able to post orders, which essentially halted the network. Or like not halted, but like it was like it became kind of unusable. But anyways, I think that was like a really illustrative and really like good showcase, and I don't think any other chain could have survived that the way Solana did. So they're truly building infrastructure for internet finance over there, which is pretty cool in my books.
Wasn't there a time? Wasn't there a time like nodes were down as well or something during the Trump situation? I think so. They were. I'm not sure if it was the nodes being down, but it's more like people are sending transactions and it's like just not hitting the chain. So
yeah, I think that was because the G2 layer, so like the MEV layer of Solana was essentially kind of like collapsing. But the details, like you can probably read in some G2 technical blog or Solana like team technical blog. But I think like the core, like we didn't have the issue that like Solana just went off, like shut down, that we had like multiple times before, but rather now like I think it's like some other part of the infrastructure essentially caved in. And if you really wanted, or like if you're a sophisticated actor and you really wanted to, you could still force include transactions into the chain somehow, but it was really hard, like not acceptable for a production use case after all. But up until then, they did pretty well, which is like I think you always need to see both sides of the coin, and like they probably onboarded like 1 million users in a day, that's super impressive.
Yeah, I think I mean, it was by no means perfect, but it was the best we've seen so far in terms of like this high demand and how well the blockchains were able to host that. I think there was also like some people incorrectly said there was a high fail rate for transactions, but that's also just because slippage was, you know, obviously high because like it's a meme coin that's just launched and prices is going to move all over the place. So it's just like there's also incorrect metrics thrown around to push it down. But yeah, it was generally really impressive. I would love to see more sustained demand like this though, and see how blockchains respond, because that would be even cooler.
Well, they're trying to move the Nasdaq on chain, so eventually you can just see I don't know, real-time stock trading or whatever happening over there. And I still today it's pushing like the most TPS out of all the kind of established chains. So
I mean, the other thing happened. I mean, this is a perfect transition towards state of DeFi. But the other thing happened that DeFi kind of outcompete the CeFi was how like October 10th, October 11, I think, when Hyperliquid was able to like basically run while like Binance had the timeout for people to not able to withdraw money. So that kind of is like another example of like, you know, DeFi runs better than CeFi. Even though I think there's like huge debate right now, if everybody paid attention to, where Dan Robinson and Tarun is debating against if Hyperliquid's ADL algorithm has basically taken more money than they should from user, etc. But that's for another episode. But yeah. I feel like no one is reading that math, but it's just like reading through like who's talking stronger. But speaking of state of DeFi, you guys also touched base on like how the year started, basically strong with a meme on Solana. Trump launched the token. I mean, I think the whole year this year was kind of crazy. Just also how like Trump, got elected again, and everything is kind of crazy after that. And I mean, geopolitical wise, is kind of also tension everywhere. But okay, that's another topic. But I think also we started the year with also some momentum coming from like the agentic trading platform thing, like AI16Z virtuals was kind of making a wave by end of last year, this beginning of this year. But now, if you look at all those tokens, it's like going to zero almost. I think it was an interesting experiment. Basically, the idea was like there's all these AI agents. They are doing all kinds of things. Maybe they're putting your money into a vault, proactively managing it, or they're launching meme coins, and people are swapping against. It's end of the day, from one of the paper I looked into with my colleague Jay, who we interviewed before. It's a bunch of agents trading each other's meme coin, and it's going to zero at the end. And you're holding the platform's token, hoping the value is going to sustain. But yeah.
But that's like the first innings of that tech being used, which is always like the first innings of any new sector or whatever you want to call it is usually I'm not going to say fraud, but there's often a lot of fraud, I guess, but also just shitty use cases. Let's just call it like this, and spam and stuff like this. But it's the first innings, and hopefully the more serious ones take a bit more time to develop and actually get integrated. But the cool thing is we have this cool new piece of tech, I guess, that could be leveraged in the future. So I would be interested to see where it goes.
I think I heard similar theory from my colleagues saying like basically whatever the sector that got like, how to say, like a hype for the first time ever, it's going to be a lot of bubbles. But if the second time it become hype again, it's usually when it actually found the PMF. So maybe in the future, agentic trading platform will become a thing again. So we'll see. But there's a lot happened, I think, in DeFi as well. So I think the more recent news, like if we're talking about traditional DeFi, we have to talk about like unification proposal. So basically like this proposal from Uniswap governance by Hayden and a few others in November to propose that we finally can basically attach the Uni token to whatever the feed that's being generated on Uniswap protocol. They gonna turn off the front end fee and also even retroactively burn, I think, like 100 million Uni token, basically say we want to retroactively also attach the past a year and a half or so value to the token. And today is December 22, and I think like Uni token went up above $6 or so for the first time ever for a while. Definitely kind of bullish outlook for Uni token. And it's kind of impossible to do so in the past years when Gary Gensler is going after all this like first wave of DeFi, but only this year now all the regulations become warmer towards DeFi. Any thoughts on that?
It's super cool. I think Hayden also clarified in a few like reply tweets about how it's essentially a move that just wasn't possible before, and merging labs and foundation is definitely something that. Well, I think it's, first of all, I didn't really fully understand the split, and it was always super confusing. So just having all one entity is like so much better for, I think, everyone involved. And alignment going to token holders is probably a good move, because maybe that's in parts what the token should be used for, is for people to have real stake at what's going on and how the protocol is being used in some way, shape, or form. So yeah, I'm all for it.
If we want to be a serious industry, we can't have these weird like double token equity, like dual shareholder constructions where, I don't know, the equity by its very definition is like more prone to be held by professional financial investors, just because like that's the way like you gain access to those through private rounds. And it's like if the retail market or like the kind of like wider public market that has like I don't know, like the quantity of stakeholders in there is always higher. The power of those might be lower though, but still, like you want to protect stakeholder rights or shareholder rights. And like what are we doing if like you're releasing a token, but then like this token is just kind of a meme? Like literally, like Zora, like I think just a couple months ago released a token, and they're like, oh yeah, this is just for fun. It's like, guys, what are we doing here? Like, this doesn't make any sense. Like, why are you going public, but you're not going public? Like, so I think this is like a huge step forward for the industry, where we're like, okay, we're actually gonna treat the token like the equity, or like the token holders are our shareholders, and like we have financial obligations towards them, and like this was always the idea. But now, like, I think that the largest DeFi protocol still like a massive kind of like power centrum in DeFi, like signaling this out to the world is very important, I think. And kind of a weird side story here, or like a tangential story, is like Axelar just last week was bought out by Circle, but like the token was not bought out. It was only like basically like they acqui-hired the entire team, but like, and the team is taking the IP to Circle, but the token holder, like the token is getting nothing. Like, they're not buying the token. Like, the token is still gonna continue, and like the token is gonna somehow kind of like uphold the. It's like an exit to the community. It's like, oh yeah, we're giving over the token to the community, and like you can still run the Axelar network or whatever. And it's like, guys, what the fuck are we doing? And like, honestly, kind of like a very, like, I don't like that Circle is doing this. Like, they should kind of like hold themselves to a higher standard, where it's like, like, sure, it's a good deal for them, and like they've now like acqui-hired like probably like 20 crack devs, and like for a very low cost, and like they are optimizing their fiduciary duty to their shareholders by entering this deal. But I think for the industry as a whole, this is kind of like, it's not a good deal. Like, I don't like that this is happening, where like a big project like Axelar, and I think like fairly successful. I feel like it's a very widely used bridging protocol. Like, now kind of like just completely rocks its token holders. It's like now everyone else who's like kind of in a, like, who has a position in kind of like a double equity token thing, like now has to kind of rethink their assumptions of like, oh shit, like my token might still just get rocked. Like, we really don't know. So I don't know. I that deal really, like, I don't know. It almost reversed like the good news that the reunification has done. Now the Axelar deal is kind of like really put a dent in the good view of that, I feel like.
It's also a byproduct of like the regulations were shit, and they basically didn't allow us to have alignment all throughout, hence the unification. So it's like, technically, Axelar and Circle are definitely within their rights, but we should make it so that hopefully in the future, other companies launching tokens just are more aligned in the first place. And therefore, it's not a possibility to do these kind of things where essentially a bunch of token holders get rugged. And yeah, I agree. It's not a best look scenario here.
There's a very recent news, or like a debate coming from Aave governance forum. So basically, like the Aave DAO holder are questioning that. So basically, recently, I believe there's an integration between CowSwap and also Aave protocol, and they noticed that the money that is being accrued by the CowSwap swaps or fees, who would used to come to the Aave DAO address, now is going to like Aave Labs address. And so the DAO, like token holder, are like, what the fuck is going on? Like, is this front end fee is going to now like the labs, but not anymore to the protocol? Similar debate. We'll see how that one goes. But yeah, I think like the tension between labs and protocol or governance seems to be getting to a new era. I don't know.
These discourse, it's a good thing that they're happening, right? It is the first step to things changing. So we'll see how those were resolved, but I don't know. I'm curious how those resolve, but I do think it's good conversation we have now, and it's good that like people ain't pointing fingers and being like, yeah, what the fuck's going on here? It's not really it's not really the original intention, or it doesn't seem like it. So yeah.
So going with my, I guess, DeFi news rundown, related to Aave, I think like actually in 2025, a competitor or so, Morpho, has been more on the spotlight. I feel like they've been really going really well in terms of adoption, and feel like this word vault curator was kind of like created after Morpho become popular. So basically the idea is like you now can design any money markets or like lending protocol with customized parameters, like how even like somebody can go basically to Uniswap v3 and launch any token, but now this time for lending protocol it's enabled by Morpho. But I think like also I've seen there are some like hacks unfortunately happened. There was this project that I think it's like called Stream Finance, and they had like a security issue, got hacked, and resulted in like a bad debt, causing like $284 million dollar in the bad debt in another protocol called RE7, which is using Morpho protocol. So it's like, again, DeFi legal situation. Yeah, the more innovation you're starting and more people are forking each other's code, and like I mean, I don't know, like I think this whole year hacks has been really, really crazy. I myself have fallen a victim, and I feel like I've heard so many people falling to like the Zoom meeting hack, and yeah, I don't know.
I agree on the individuals getting hacked, and there's much more targeted attacks, which are kind of scary, and also put the whole idea of self-custody also back into question of like maybe we should be more careful, and maybe self-custody isn't always the best way to go. I do think it's definitely not the best for everyone, and having good custody systems is also good. On the protocols getting hacked, I've never heard of neither of those protocols, to be honest. I leveraged Morpho, and by the way blockchains work, anyone can integrate anyone. So I don't know. I haven't seen any like huge major hacks aside from like the Bybit hack earlier this year, which was probably one of the biggest. I think, was it $1 billion or so? I can't really actually remember the exact number, but it was huge. But I haven't seen actually as many protocol hacks as earlier years in crypto. I do feel like it's.
But what about Balancer? Balancer got hacked like twice, I think, this year or so.
Yeah, fair. Yeah. I'm not necessarily super clued into what's going on in Balancer, to be honest. So I haven't been following closely. But I would say for me the major protocols, the Uniswap, the Aave, and all the such like it, are getting to a point where they're battle tested enough to. It doesn't seem to be getting hacked as frequently as they haven't necessarily had huge hacks, but like it's like. I think we're starting to be in a good space and like battle testing for these protocols that are seeing such huge use case relative to the rest, are bringing confidence, right?
Yeah,
I would agree. I think one quick correction here: RE7 is like their capital management firm, which is hosting bolts on Morpho. They're not a protocol themselves. They're kind of like the same way that Stakehouse is kind of like hosting vaults, or like they're curating vaults on Morpho, and then they're just using other protocols downstream, or like they're doing some kind of. It's essentially like people are taking like the toolkit of financial engineering, opening a Morpho vault, and then they're just like, okay, like we're kind of like, this is a mini hedge fund. Like our strategy is XYZ. We'll execute the strategy on chain, and you just kind of like entrust RE7 or Stakehouse or whatever with your money. And like Morpho has kind of like evolved from just being like a pure kind of like lending borrow like platform to like, oh, it's just like you can be a yield manager there and you can just do your stuff, which I think is like it's just like in the trend of the platformization of everything. But it's like Morpho is kind of like, like we're not gonna like Aave is curating all the markets themselves, right? Like they're like, oh, okay, like this is risky, this is like medium risky, and like the Aave DAO governance, they like decide on these risk parameters, and like they work closely with
Chaos Lab.
Yeah, exactly. And like now it's like, like why wouldn't we do this ourselves, or like we can just do this ourselves. So I think that like whole trend is super, super interesting, because like again, it just kind of like democratizes access to more sophisticated financial products.
I'll just say one last thing about DeFi. I think like the hype this year are definitely Perp DEX, prediction market, and the stablecoin chain. I think like prediction market, we're not gonna like expand too much, but at some point Polymarket had the 10 billion evaluation announced, was I believe like zero fee charged at the time yet. I don't know today. I think still no fee yet. And then Kalshi quickly announced like I believe also 10 billion as well. So I feel like every VC now is trying to place a bet on like prediction market vertical. So we'll see how that one turns out as well. But yeah, otherwise, Hyperliquid really definitely like started the Perp DEX boom. Every chain that's about to launch already have Perp DEX that's trying to launch on that chain. Like Monad has Perp DEX, Mega ETH has Perp DEX, and Solana Breakpoint had a lot of Perp DEX announced. But yeah, I think all these things will play out in a year or two. But otherwise, curious your takes.
Yeah, I think prediction markets are definitely doing pretty well lately. It's also a case of like Kalshi was the first to have like regulations and be approved in the US, which is really cool. Polymarket is more for the rest of the world currently, but also getting licenses to be used in the US. So it's like there's the regulatory landscape for prediction market is starting to clear up in a way that makes them more available worldwide and allows for more markets to be traded. Overall, a very positive thing. And yeah, for perps, they're popping up everywhere since Hyperliquid. I even saw Synthetics launching perps on Ethereum mainnet like 2 days ago. Now there's obviously some off-chain component here, but it's they're popping up everywhere, and they're obviously people are noticing that Hyperliquid is doing super well, so might as well try to do the same, I guess. So yeah, trade everything is probably where we're headed for blockchains, and I think that's pretty cool.
Those topics are actually very relevant to start comparing some of the chains, or like kind of like zooming out a little bit and seeing where are we at, and like how do all the different chains stack up against each other. I think there's like a few clear trends. I think first of all, if you kind of like look at the stablecoin supply, which is like stablecoin supply kind of is like stablecoin is the one real use case that we found for blockchains, and supply is kind of like the one ungameable metric that we have for like, okay, like there's actually seems to be a demand to have these stable coins on chain, like token transfer volumes, DEX volumes, like all of these things can be like somewhat faked. Like if you just look at like token transfer volumes for stable coins or like DEX volumes, like all of these things are like, yeah, they're like indications, but like what's really happening behind the scenes, like you need to be very exact in your analysis in order to be able to figure that out. Whereas with supply, you're like, yeah, there's like a real US dollar that's just like, it's not sitting in the traditional banking system. It's not sitting on whatever Visa or MasterCard ledgers or PayPal or whatever. It's like, no, it's sitting on a public blockchain, and it's probably sitting there for a reason, because those owners feel like their money is more secure there, or they have more kind of flexibility with it, or they want to deploy it into some whatever yielding stablecoins there, or I don't know. There can be like a million different reasons, but like that seems to be a clear product market fit. And then if we actually start looking at the data, surprise, or I think unsurprisingly, Ethereum still absolutely dominates this. So if we look at the data from DeFi Llama, we'll find that the Ethereum stablecoin market cap as of December 2025 is 180 or like 100, oh actually 166 billion US dollars, and then quickly closely, not closely followed, Tron has about half of that, which is 80 billion, and then we very quickly go down the line, or like the values quickly go down, with Solana at 16 billion, Binance Smart Chain at 14, Base at 4, and then kind of like Hyperliquid, Arbitrum at 4, Polygon still kicking with 2.8, which is a surprising amount for Polygon, I would think. And Plasma and Aptos are also like there with almost 2 billion, which is interesting to me. What are people doing?
I didn't know Binance was so high. Binance Smart Chain. I don't know.
It's probably part of the Binance like operations, just like they use their own chain, the same that like Coinbase is doing with Base. Like probably like most of the Base stable coins. And like this is where like it needs more analysis. Like this is even where this metric is kind of flawed, where I'm like, okay, like how much of the like Ethereum based stablecoins is literally just exchanges kind of holding their customer deposits on Ethereum, just because like that's the most battle tested chain, you can always rely on it. It's like if you have a cold storage wallet with like several, I don't know, tens of millions or even $1 billion of stablecoins, like you'll probably have that on ETH mainnet. Like I wouldn't be comfortable holding that anywhere else. So like how much of this is real, how much of this is just kind of like exchanges holding balances. I think that like requires some more analysis, and this metric is imperfect as it stands, but still like it kind of indicates like a demand for stablecoins on certain chains, whether that is user preference or like it's just kind of like I think there's also a lot of, how do you call this, like a historical dependency here. Like if we were to like distribute these in new today, like the distribution would probably look different, but just because like history has played how it has, it's like Ethereum is the dominant stablecoin chain. And I think to some extent it's also like it is still the dominant DeFi chain. Like there's no two ways about it. If you want to do like any serious lending, vault curation, like financial engineering type products where it's like, oh yeah, I'm getting like whatever 10% yield on my US dollar stable coins, isn't this cool? Like this for sure happens on Ethereum. There's like nothing like this would happen on Solana, even though there's like some move towards this with like some RWA products that you can then loop and kind of like do all of that stuff. I think Solana is somehow getting there slowly but surely, but I think Ethereum like is very far ahead on the curve here.
It is still the most trusted layer in terms of decentralization and like battle testing, in terms of, you know, historical uptime and all this relative to the rest. So it's also, there's definitely latent effects of like capital has been gathered for a while and not necessarily just recently, but also I think like if I were to host, you know, my capital somewhere and I wanted to be super trustworthy, I think Ethereum would be the place to go. Probably not obviously for throughput, not as much, definitely. But if you just want to host capital and use it for low, like not high frequency stuff, then Ethereum is probably the best place.
Yeah, that's what the numbers seem to indicate to me as well.
Yeah.
Then kind of like the other metric that really moved the industry this year, Aave, obviously popularized by Blockworks. Also, this chart here is from the Blockworks research website. So I think the big story here is that the Solana Aave, like if you guys remember, we did talk about this in the podcast, or I did give a talk at East Berlin, not Zuberlin, about Aave and like what are the dangers of Aave, and some of these things have actually played out, which is very interesting. So like in Solana land was kind of diluting itself, and most of this was just very path dependent on meme coins staying successful, and meme coins have not stayed successful. And also I think the MEV infrastructure has probably like upgraded a little bit on Solana, which like makes like you don't need to pay like huge fees anymore, huge tips, but rather like there's more competition in the market. And
wait, isn't on the last day like Aave lower than on Ethereum even?
Well,
crazy.
Let's
sorry, my bad.
Let's take stock of the November as of November 2025. Hyperliquid is actually the chain with the most Aave, which is of course Hyperliquid is an app chain. So all the value that gets created in the Hyperliquid kind of like Perp DEX and like the fees that they're taking for that is calculated as the Aave here, which it's also like it's kind of like an application and the network at the same time. But like I think that's fair. It's just an app chain, and like you kind of need to think about or like I think it's totally fair to include in this category. And then so Hyperliquid sits at $73 million monthly income or revenue. How much of that actually translates into earnings, that's a different question, but probably a lot. I don't think Hyperliquid's operating costs are too high. Then Ethereum sits next to that at 32 million, then Tron, and then we only have Solana. And this is not a recent trend. If we look into October, Ethereum also has higher Aave than Solana. If we look into September, Solana actually is higher, but like Solana and Ethereum kind of like switch places, and in the last 3 months, Ethereum has had more Aave or like network revenue than Solana, which is a very interesting story. Still, of course, the Ethereum network value is like network revenue is not super high. It's like 32 million for an asset which market cap is oh god, what's the ETH price? How many ethers in circulation? I forget. Like, are we at 200 billion market cap, something like that? I honestly have no idea. I don't look at the markets a lot. But still, like, the PE ratio with whatever number you're calculating this is pretty low. I think Tron here is like I've looked at this chart like a million times at this point, and I'm always surprised by Tron being here. With Tron is actually earning like almost $30 million per month with whatever. Like, nobody can really say it seems to be stablecoin transfers, but like, is this more exchanges doing this? Is this retail users? Is this, I don't know, is this money laundering? Like, is this crime? Like, who the like? I don't want to like put any false accusations into the world, but it's very interesting.
It's supposed to be B2B, right?
Who knows?
I don't know.
Go ahead, Denning.
So recently I dived into like Tron fee mechanism, and it's like actually insane. How to say, complicated. If you just calculate like the gas fee for even USDT transfer using Dune data, it will show you each transfer of USDT is like $2-3. But there is like a mechanism where you can stake amount of value into the network, and then a lot of the gas are discounted or something. So I wonder if this is calculated directly using basically like whatever the gas mechanism on Tron, but actually it's not really charged. Worth digging into.
I would think that Blockworks has probably corrected for this. I'd be very surprised if they just take like the very naive value. Like, I don't know, that would be out of character. So I would trust this at face value, and like I've also I feel like I've seen this like replicated across other sources. But yeah, we should research this after the pod, and we'll put it into the footnote. But yeah, Tron has built like an insanely complicated like gas fee concepts and like energy and sun and like all of that jazz. It's like it's horrible. Honestly, it's rough. But yeah, I think other than that, about the RV data, I think Tron and Hyperliquid, very interesting outliers. Other than that, kind of what you would expect. It's like BNB shows up in here with $16 million per month. Base and Arbitrum show up. Polygon doesn't even make $1 million a month, but is on place. What is this? 7, 8, 9, something like that. Basically, like there's a very uneven distribution. With Hyperliquid as an app chain taking the most, Ethereum taking like 32 million out of like in total, like all the whatever, like the relevant networks. The top, is this the top 10? 2, 4, 6, 8, 10, 12, 13. Okay. We have 13 chains that in total make $200 billion. And there's a very uneven distribution here with million with the top 5 basically making 150, and then like the slope really drops off very quickly. But yeah, moving on to the final data point, which is application revenue, which essentially is trying to express how good of a business environment is your chain for startups building like their own applications. How many users are there that are actually willing to spend money? And this data is actually getting like really hard to come by. This is like, I feel like this is kind of the latest evolution of like DeFi metrics or like the revenue meta. So like this is a very hot metric, and now like DeFi Llama is completely like DeFi Llama is basically just on the free version. It's giving you like the app revenue of the last 24 hours and the app revenue of the last 30 days. But like trying to find like the daily breakdown or even the monthly breakdown of historical data, like Blockworks doesn't give this to you, Token Terminal doesn't give this to you, DeFi Llama doesn't give this to you. And essentially beyond that, there is no like trustworthy data sources. So it is kind of a shame. But with what we can go by here is that the app revenue for the last 30 days on Solana has been 112 million, and then closely followed by Hyperliquid with 80 million, Ethereum with 63 million, and then kind of like we see BSC, Base, Ton, Arbitrum, Polygon, Sui, and it kind of slopes down from 20 million to 3 million very quickly. So quite interesting here that like, even though Solana, like, I don't know, the meme coin circus has stopped, and like, I don't really know what's happening on Solana that much, but it still seems to be the most, or like the most attractive environment to essentially build a startup in terms of like, okay, well, how can I actually, or like, how much revenue can I actually generate? So maybe there's something unique about the Solana user base, that they're like willing to take more kind of gambles or risks, like pay more fees to their protocols in order to like get a higher pay, or like get the chance of a higher payout or something like this. I don't really know. This would need some kind of like further research into the data, and like I would need to have a more accurate look about how like all of these kind of like look like. But I think right now, this is also like, this was a huge narrative that the Solana Foundation pushed at Breakpoint, of like, Solana is the most attractive place to build your business if you look at application revenue, and then kind of like singling out success stories like, I mean, Phantom is absolutely printing money. The Pump.fun guys absolutely printed money. Jupiter is absolutely printing money. Even some of the lending protocols on Solana have absolutely like, they're making a lot of money. So in that terms, like, it does make sense. But yeah, this is also like,
to put the number into perspective, right? It's like 100 million for 30-day. Like 100 million, you can pretty much put like a 1 billion evaluation. And so basically, if you annualize this number, Solana has 10 to 12 unicorns based on the data.
Yeah, we can actually, so DeFi Llama does give you the data of like, you can actually click in here, and it's Jupiter, Pump, Axiom Pro, Godel protocol, which I've never even heard about. Phantom, and Fun, Meteora, Dex Screener, or protocol, and then Solana itself, just like the RDV fees. So it is a lot of trading. It's still like Jupiter, Pump, Phantom, like all of those, even two like trading apps here. So overall, like, it still seems to be fueled by the meme casino. But if that's the case, like, that just proves like the point from earlier, where we're like, okay, Solana is uniquely the chain that has like the TPS, or the throughput, to sustain a lot of these trading apps. And even with the evolution of like on-chain order book dexes that now kind of exist on Solana, or like, how are they called, on-chain prop trading firms with like, there's a bunch of prop AMMs, which is basically like, they're kind of putting quotes on chain. It's kind of like similar to the intent system on Ethereum, but they're almost like an order book, where like, they just put these quotes on chain, and then you can trade against them. Like, somebody has built infrastructure for a bunch of different teams to put quotes on chain, and then you can just trade against them. And they're now making up like 70% of Solana DEX volume. It's like crazy.
Oh wow, yeah, okay. Oh wow. Okay, wait, and that's not a thing on Ethereum at all?
No,
I didn't know.
No.
Okay.
How would you do this? The block time is 12 seconds.
Yeah, fair. Yeah, very fair.
Yeah, so Solana seems to be a very good business environment for people, as we've already talked about earlier, with like kind of like the TPS they are able to sustain. It's really attractive to build trading apps there. The numbers also seem to very much support this, where like, I don't know, like, Solana's DEX landscape has now been overtaken by something called prop AMMs, where like, they're making use of the speed of Solana to like essentially like kind of replace the or AMM structure that's like prevalent on EVM chains. So like, actually innovation is happening there. Pretty cool. Yeah. And yeah, we'll see like how all of this goes. And like, I think like the slow money keeps staying on Ethereum. Then there's like a hot ball of money that's kind of like moving between app chains. There's something happening on Tron that nobody really knows about. Like, across all of these metrics, it's just like kind of an outlier that nobody can really explain. Also because the data structure is so horrible, and like, it's really intransparent, and nobody can really figure out. I think there's like a lot of backroom deals in the end of like, what the hell is happening in Tron, of like, we're gonna like settle our stablecoin transfers over there, and like, we'll hold our balance. I don't know. It's a mystery. But yeah, that's my, I think, predictions. There's going to be more app chains that will pull in higher revenue. Something like Lighter. Polymarket is now considering launching their own chain, since Polygon recently had like a really deep reorg, or even halted. I'm not familiar with the details. But probably more app chains that will actually pull in like revenue. I feel like this thesis has been going on forever, or like the thesis has been made for a long time. But 2026 might actually be the year where this plays out. Going to be very interesting to see the stablecoin chains, like I mean, especially Tempo, like see how much revenue they're bringing in, or if they're even optimizing for revenue, or if this is like purely we're gonna like build the best blockchain for distribution. All of those things, like all there's a lot of territory to grab, and there's a hot ball of money, as we see with the like rise in total value secured and like the rise and fall of REV of like different chains. If you succeed today, that doesn't mean you'll succeed tomorrow, except if you're Bitcoin and Ethereum. Kind of, there's so much like historical path dependency there, and Solana also. Like some things have become lindy enough, but the rest is like you can always just come from nothing like Hyperliquid and just overtake all of them. So yeah, exciting times. This was I think 2026 is definitely kind of like a make it or break it year for the whole industry. I feel like it's gonna be very interesting. Any last words you wanna add to the episode, Dobby?
I think we're at an exciting time, to be honest. I feel like the market might not be in its best state in terms of valuations and everything, but like actual technical investments are happening. So are in terms of regulation as well. We've had a few unlocks recently, not necessarily major and flashy, but behind the scenes, things are happening. There's app chains popping up. There's new sectors like prediction markets that are doing pretty well. So yeah, I kind of like where we're headed.
Yeah. With that, you have listened to the Index podcast. We've unfortunately lost Danning along the way. We wish you all happy holidays and a happy new year, and we'll catch you in the next year. Crypto day wizards, come join us for the parade. From Bitcoin ETF to Solana and coin trade, uncovering public secrets in the blockchain shade. Bad chiller, cherry picking liar. We call them out and set chart crown on fire.